In this video, we're going to go through the journal entries that we'd make for a notes receivable. So if we look at this example, it says on March 31st, we had a $10,000 4-month 6% interest note, and the year end is June. So there's two ways that this $10,000 note could have been created. The first method would be if we as the company lent somebody or another company money. And so in that case, we would record notes receivable for $10,000, and then we would credit cash for $10,000. And I'll just say lend money. Or another way that this could happen is we could pretend that we sold some product to a customer and they were put into our accounts receivable, and then for whatever reason they weren't able to pay their accounts receivable. So instead of writing them out, you can agree with each party to turn this into a note and then start charging them interest, and then maybe having a different payment plan come up. So in that case, I would still have my notes receivable for $10,000. And since we're going to now take them out of our accounts receivable, I'll have to credit accounts receivable to bring that balance down by $10,000. So basically, we're transferring them out of accounts receivable into our notes receivable. So I'll just call this note in settlement of an account. So either one of these journal entries would have been made on March 31st. So now the second journal entry that we would need to make is our interest payments. So each note is going to have a different term involved. So you'll have to watch out to see if the interest is due monthly, if it's due quarterly, or if it's due when you have to get paid back for the money that you lent. So in this case, we're actually just letting our person we lent money to, we're letting them pay us back interest at the end of the term. So that's a 4-month note. So the next journal entry then would just be our year end. So just remember, at the year end, because we haven't completed this transaction, we'll have to record interest revenue. So I'll set up a receivable account because we're not actually receiving cash. And then I'll set up an interest revenue account. So I actually want to record the interest that is accrued from March 31st to June 30th. So I think the easiest way to do this is to take your principal amount of the loan, which is $10,000, and multiply it by that 6%. So whenever they give us an interest rate, it's actually for the year. So that gives me $600 of interest per year. And now what I'm going to do is divide this by 12. And that will give it to me monthly. So when we're doing our adjusting journal entry at the end of the month, we have to watch out for when the adjustments get made, because some companies will make the adjustment every month. That means I would put $50 down, and then other companies will just wait till the year end to put the adjustment. And so in this case, we're just adjusting at the year end. So then I would have 3 months worth of interest that I'm going to accrue. So that would be June or March. So that'd be all of April, all of May, and all of June. So that's 3 months. So that'll be $150. And once you make that journal entry, then we can just go to the end. So on September 30th, this is when we're going to settle the note. So we definitely know we're going to get cash. So they're going to pay us back that $10,000 plus interest. So once they pay that note, I'm going to credit the notes receivable. For this $10,000. So if I credit that, I bring the balance down, and now that's to zero. So that's off my books. Then I'm going to credit the interest receivable. So if I credit that, I bring the balance down by $150. Then that cancels it out and takes that off the books and brings it to zero. Then I'm going to also credit my interest revenue. So I recorded 3 months of interest in the previous year end, and now that means it's just 1 month of interest in this year end. So that's 4 months. So that's $50. And then I can take these, add them up, and then I'm going to actually receive $10,200 from the person I lent the money to, and then our business transaction is complete.